Hello friends, my name is Behroz. I'm a finance executive by profession, and in this video I will explain to you why you should shut down your Tfsa account before you move from Canada to US to become a resident of US. When I say shut down your Tfsa account, I mean sell all your assets which are in the Tfsa account, take out all your cash and close your Tfsa account before you move to US to become a resident. If not, then be prepared to expect huge fines and huge tax bill. And hence in this video I will explain to you exactly why you need to close down on your Tfsa account, because it is more beneficial for you to shut down your Tfsa account than to maintain it. But before going into the video and into the details, I have special ask for you, which is in case you find any value from this video, please smash the like button, as this keeps me motivated so I can improve the quality and quantity of content that I post on this channel. And secondly, please make sure you subscribe to the channel as well, because on this channel I post content pertaining to how you can achieve career success and financial success. So any of these two items are important to you, which is how to become successful in your career and how to become wealthy and successful with your personal finance, then make sure you subscribe to the channel. Now let's first talk about what is Tfsa. If you are living in Canada, you can contribute to Tfsa after you've paid tax on that particular money. You can contribute that money into Tfsa. You can buy assets, equities and bonds with the money that you have in your Tfsa account, and any capital gain that happens in that particular account from the investments that you've made is tax free. So typically speaking, when you have a capital gain or you have dividend income coming in your accounts or your investments in Canada, then you pay tax on it. However, if there is any capital gain or dividend income coming in the account, which is Tfsa account, in the investments that you've made in the Tfsa account, then you pay no tax on it at all, which means everything that you have in your Tfsa account grows tax free, and you don't pay any tax on dividend as well. Let's take an example. Let's say your investment value in your Tfsa account is $1,000. So you buy assets worth $1,000. Those assets grow up to $1,200 and also pay you $10 of dividend in year one. This $200 of capital gain, you pay no tax on it. You can take out this money altogether. And the $10 of dividend that you get in this account as well, also you pay no tax on that particular dividend as well. So win-win, no tax, and your money grows tax-free, which is amazing, especially in a country like Canada where taxation is very high. So this is what Tfsa is about when you're living in Canada. Now here is why you need to close down on your Tfsa account once you move to US. I will break it into two parts. One is why you need to sell everything that you have in your Tfsa account altogether and only move to US as cash. And second part is why do you need to shut down your account? So let me explain why you need to sell all the assets that are in your Tfsa account. Number one is that IRS, which is the taxation authority in US, does not recognize the tax-free status of Tfsa, which is any capital gain that is occurring on the assets that you have in your Tfsa account are taxable in US. So you lose the tax-free benefit of the Tfsa account altogether. Plus, any dividend income that you are earning in this account is also taxable now. So everything that was non-taxable while you were in Canada, while you were the resident of Canada, now becomes taxable. So this is one reason why you need to sell everything that is in that account and make benefit of the capital gains you've had and not pay any tax on it altogether. Second is that even the amount or the capital gain that occurred during the time you were in Canada now becomes taxable in US. Let's take an example of you buying assets worth $1,000 which grew up to $1,200 the day before you moved from Canada to US. Now, if it was any other account which is a taxable account in Canada, then what IRS or US does is it assumes $1,200 to be your new cost base. So they say that if you are moving to US from Canada, anything that was already taxable in Canada, the asset value is $1,200 and this is your new cost base. So now when we calculate capital gains, we calculate capital gains starting $1,200. So if $1,200 becomes $1,300, then the capital gain is $100 only. And if it doesn't become $1,300, if it stays $1,200 altogether, then there is no taxation the day you sell it, which is whenever you sell it, whenever you realize that particular stock sold or realize that particular gain. However, in case of Tfsa, since this was non-taxable in Canada and IRS doesn't consider its non-taxable treatment, so the day you move to US, the cost base doesn't change to $1,200. The cost base is still $1,000. So let's say if later after 6 months or a year you decide to sell those assets for $1,200 because that is the value of the assets, your $200 gain, which could have avoided all the tax if you had sold it before moving to US, now becomes taxable. So you are better off selling those $1,200 worth of assets while you were in Canada, not pay any tax on that capital gain, and start with $1,200 worth of cash in your TFSA account, let's say, and then purchase assets if you later want to purchase assets using your TFSA account. This way you have kind of pocketed that capital gain without paying any tax on it. While if you move to US, have not sold those assets, and those asset value is still $1,200, while your cost base is $1,000. Now, if you sell it for $1,200, you have to pay tax on that $200 capital gain. So just by moving to US, within one tax cycle, you end up paying tax on that capital gain, which could have been easily avoided if you sold those assets in the TFSA account while you were in Canada. So these are the two reasons why you should sell everything that is in your TFSA account. Now, one important call out, because this is very important and pertains to the topic that I'm talking about. It is highly important that when you are in a situation where you're moving, especially from Canada to US, that you don't do your taxes yourself. Do it yourself taxes were good when you were in Canada. It becomes very complicated when you're in US, and it becomes even more complicated when you are doing a cross-border taxation. Like, there are assets and income within Canada, could be a rental income, could be some dividend income, and you also have some income in US because now you're living in US. So you also have to file tax with IRS and with CRA at the same time. So in such regards, it is best to go for a tax accountant and not do it yourself kind of thing with regards to such taxation. What I can do is I can recommend the accountant that I make use of for my cross-border taxation. I've been using him since the time I moved, because I moved from Canada to US as well. And this all discussion information is very close to my heart because I've been through all of this. So in case you are interested, you can use the tax accountant that I make use of. He's a cross-border taxation expert between Canada and US. I will leave his link in the description of this video. Using that link, you can book a consultancy call at a 30% discount, and this amount that you will pay for the consultancy call will eventually be used as a credit against the eventual services that you will make use of using this particular tax accountant. I asked him for the special request for my followers so they can benefit from this tax accountant as well. So I highly recommend you check him out and get all your questions sorted and make use of this particular individual to file your taxation between the cross borders. Now let me share with you 3 reasons why you should shut down your TFSA account. Not just sell the assets, but also take out all the money and close the TFSA account altogether. Number 1 is you cannot contribute further in the TFSA account in Canada. If you contribute, you will have to pay a penalty of 1% per month of the extra contributed amount, because now you're not a resident of Canada. If you're not a resident of Canada, you cannot contribute to your TFSA account. So the contribution cannot happen. So it's useless from that angle. And the second important reason is, which is kind of the most important reason, is that you have extra filing requirements. So once you're filing your tax in US, you have extra filing requirements for 4 additional documents. The first form that you have to fill is Form 1040, which is to report your capital gains and dividend income coming in that particular form. So even if in your TFSA you've sold everything, you're just holding cash, you still have to file Form 8938, which is to report what assets you are carrying in foreign country. Another form that you have to report or file as part of your tax return with IRS is Form 3520. So you have 3 forms that you have to file, which is 1040 if you have income. Even if you don't have income, you still have to file another 2 forms, which is Form 8938 and Form 3520. This is with IRS. And then there is a 4th form, which is with money laundering authorities, called FBAR FinCEN Form 114, where you have to report that you are carrying this much cash outside of US. Again, this has nothing to do with IRS. This is a separate authority where you have to fill in these forms. All these forms that you have to fill in now will cost you more, because you will have to file through a tax accountant, and they will be charging more of accounting or submission costs for your taxation based on how many forms they have to fill. So the more work for them, the more will be the cost for you. So avoid all of that cost. Just take your money out and close down your TFSA account so you don't have to fill in these extra filings that are required. And in case you miss on any of these filings just because you made a mistake or your tax accountant made a mistake, then my friend, you are welcoming some penalties your way and extra taxation which may come your way. You don't want to be in that situation where you are paying extra penalties on something which is kind of useless, just cash lying there. And this brings me to point number 3, which is, what's the point of keeping cash on TFSA account when it's of no use? You cannot invest it, you cannot let it grow. Rather, you take out that money, bring it into US, and maybe invest it in Roth 401k, where you can let that money grow tax-free. Again, having the benefit that you had in US with TFSA account, you can have that benefit with Roth 401k account. So put it in a Roth account in US and let that money grow tax free, or invest it somewhere else wherever you would like it to grow, as against just leaving that cash in the TFSA account. Now, with all this, someone might wonder, which is, what if I want to go back to Canada? Well, if you want to go back to Canada in a year's time, maybe it's worth taking all the pain and still doing all these filings and keeping your TFSA account. But if you are here to stay for, let's say, 2, 3, 4 years, 5 years, or even longer than that, the longer you need to stay in US, the better you are to get rid of the TFSA account altogether. As I said, there will be additional costs with regards to filing. But then you go like, oh, I'm a Canadian, I eventually want to go back to Canada and I don't want to lose this TFSA benefit. Well, the good thing is you will not lose your TFSA benefit. So let's say you have $100,000 in your TFSA account. You sell all that asset, you have that $100,000 worth of cash, you take out $100,000 from your TFSA account in, let's say, year one. You move to US and after 5 years you come back to Canada. Now your contribution room starts again with $100,000. So you can simply add $100,000 in your TFSA account back and start investing that money and let that money grow. So it's just like you never lost that contribution altogether. You always have that contribution amount. What you're doing is you're selling your assets, taking that money out, putting it somewhere else, letting that money grow. And then when you come back, you can put exactly that $100,000 back and start from almost ground zero, or from the place you initially left, which was your asset value of $100,000. In case you found value from this video, note that I will be making additional videos which I will be leaving on my channel, where I will talk about how you should treat your RESP account, how you should treat your FHSA account, how you should treat your RRSP account, how are they treated across the borders, and what you should be doing with those accounts and the asset values in those particular accounts. As I said earlier, it is always best to find a tax accountant. The tax accountant that I use, because I've moved borders from Canada to US, I will leave the link for that particular tax accountant in the description of this video. You can check them out, and if you use that link, you will also get a 30% discount in booking a consultancy call with them, which is the amount that you can also use as a credit against the final services that you will purchase with that particular accountant. So I asked him if he would be interested in me recommending him to my followers, because there are a lot of people who come to me asking me to recommend them a tax accountant that I've used for the cross-border taxation purposes. This individual is a cross-border taxation expert, so I highly recommend you check them out and avail their services. Thank you guys for watching this video, and please make sure you like and subscribe to the channel as well. Thank you.